In this video, we're going to look at how to do final accounts for a sole trader and a company. This is specifically geared toward question 1 of the Irish Living Cert, but since these core principles apply to real-world accounting too, it's a great way to verify what you already know. Alright, let's start with the basics. In the Living Cert, question 1 is always a final account, and you only really need to focus on two main types, which are sole trader. This is a business owned by only one person, so you'll see more drawings, which is the owner taking money out, and capital transactions. The net profit at the end belongs entirely to the owner. Then there is company accounts. Those are business owned by shareholders, so instead of drawings, you'll see dividends being paid out from the profit. Here are the key things you need to know before we jump into a question. First, in the trading profit and loss account, which we just call the P&L, you only record expenses and gains that relate to the specific financial year. To picture this, imagine a company called No Name. Their financial year runs from January to December, and they decide to pay for an advertising campaign starting in January and running until June of next year. The total bill is 18,000 for 18 months. Because the P&L only cares about this year, we only include the 12 months that fit in the current financial year. So we find the monthly cost, which works out to be 1,000 a month, and multiply by 12. So 12,000 is the expense for the year. The rest is pushed to the balance sheet as a prepayment. Second, you have to know the layout. If you're doing the exam, this layout is non-negotiable and it goes like this. You start with the sales. This is the money you made selling goods. Then you subtract your cost of sales, which is what it cost you to get those goods ready to sell. And the formula is opening stock plus purchases less closing stock. When you subtract cost of sales from sales, you get your gross profit. From there, you subtract your running expenses, which are split into administration and distribution, and add any operating income, like discounts received. This gives your operating profit, and finally, add an investment income, subtract the debenture interest, which is your loan interest, and you're left with the net profit. For a company, you then subtract your dividends to get the retained profit for the year. Third, you have to know the theory, which basically means you have to know what goes where. Alright, expenses and gains go into the trading profit and loss account. Assets and liabilities go into the balance sheet. Assets are things of value you own or money you're owed. Liabilities are debts or money you owe to others. Okay, that is the core logic. Now let's look at the past paper to see exactly how it works. Right, we're looking at the final accounts for Kevin Clifford on the 31st of December 2025. The first heading is sales. In this case, Kevin sold 1,740,000 worth of goods. Next is less cost of sales. Remember, this isn't everyday expenses like advertising. This is strictly the cost of acquiring the goods to sell. As I said earlier, cost of sales is divided into opening stock, which is the goods sitting in the warehouse on January 1st, and that is 90,400. We add our purchases, which are the new goods Kevin bought to resell during the year, which is 1,164,400, and then we subtract the closing stock, which is the goods left unsold at the end of the year, which in this case is 93,500. We subtracted because we didn't sell it, so it shouldn't count against this year's sales. Now if we do the math, our cost of sales works out to be 1,161,300. Now we subtract that from our sales, leaving us with a gross profit of 570,700. Now we have our gross profit, but we still have to pay the bills to keep the business running. These expenses are divided into two categories. Distribution expenses, these are the costs directly tied to getting the finished product to the customer. Think of delivery vans, advertising, and sales commissions. Then we have administration expenses, which is the cost to actually keep running the business behind the scenes. Think of office rent, secretary's wages, or insurance. If you get stuck on the exam, just ask yourself, does this relate to the selling and moving of the product, or just keeping the office lights on? Once you subtract both set of expenses from your gross profit, you will find your operating profit, which works out to be, in this case, 321,005 euros. But we're not done yet. Sometimes a business makes money too, which is called operating income. This is not money made by selling goods, but more money on the side, which, for example, could be a spare room that the business is renting or a discount from the suppliers. Now we add this extra income, which in this case works out to be to 21,750, get our total operating profit of 350,755. Finally, to get our real profit, we add any investment income we earned during the year and we subtract the interest we owe on our mortgage. This leaves us with our final net profit of 350,608 euros. That number is incredibly important because it carries over to our next section, which is the balance sheet. Alright, the top half of the balance sheet lists everything we own. And first we have, in this case, fixed assets. These are long-term items we intend to keep for over a year. They are broken down into intangible assets, which are things you can't physically touch, like a patent worth 50,000 in this case, and tangible assets, which are things you can touch. Here we have our buildings and delivery vans. We record their net book value, which means their original cost minus the value they lost over time, which is called depreciation. This gives us 1,300,375. And then we have financial assets, which are long-term investments, like in this case the 220,000 tied up in a 6% investment. Alright, next we look at our short-term money, and this is called working capital. It is the money moving in and out of the business daily. To find it, we take our current assets, which is money we have or we receive soon, like closing stock or money owed by debtors, which in this case is 186,680, and we subtract our current liabilities, which is money we must pay out within a year, like short-term creditors, bank overdrafts, or Irish taxes like PAYE, PRSI, or USC, which in this case is 88,857. Subtracting those gives us a positive working capital of 97,823. When we add our fixed assets and our working capital together, we get our total net assets, which is 1,618,198. This is the total worth of the business right now. But every single euro of that had to come from somewhere, and that brings us to the second part of the balance sheet, financed by. This section explains where the money came from. Some of it is borrowed long term, like a 400,000 mortgage. The rest comes from capital and reserves, which is the owner's own money. We put in the original capital, any reserves, and we add in that net profit of 350,608 that we calculated earlier in the P&L. Because it's a sole trader, we also subtract the owner's drawings, money they took out for personal use. When we add the mortgage to the capital and reserves, the total capital employed is exactly 1,618,188. The top half matches the bottom half, so this accounts balance, and so the question is correct.